Welcome back to the deep dive. We are doing something a little different today. We're pulling back the curtain on a world that sits right at the intersection of, well, high finance, computer engineering, and, let's be honest, a little bit of gambling
Yeah,
psychology.
just a little.
We are talking about the algorithmic trading blueprint.
This is the big one. This is, where the rubber meets the road. Or, as we're probably going to find out, where the rubber meets the swamp.
Exactly. We are tackling a subject that I think keeps a lot of people up at night, specifically the kind of people who, dream in Python code and spend their weekends just staring at candlestick charts. We're trying to answer that painful, burning question: why does the perfect strategy, the one that made millions in the backtest, absolutely faceplant the second you turn it on with real money?
It is the classic trader's dilemma. It really is.
Yeah.
It's the difference between theory and reality. And, the answer usually isn't that your code is broken.
Right. I always assume I missed a semicolon or something.
Yeah, or that your entry signal is wrong. The answer is usually that you built this perfect Formula One race car, but you're trying to drive it through a muddy swamp.
Mm.
You haven't accounted for the environment.
The market regime.
The market regime, exactly.
I love that analogy. And we're going to be unpacking exactly how to fix that today.
Yeah.
This deep dive is specifically for the learner out there who's ready to move beyond just staring at charts and, drawing support lines by hand.
Right. We're talking about engineering a system.
We are. And we have a serious stack of sources today. We're pulling from academic papers on high-frequency Gaussian mixture models.
Try saying that 5 times fast.
I won't.
Yeah.
We're also looking at practical guides on the Binance API architecture and some really deep technical breakdowns of indicators like ADX and Bollinger Bands.
Yeah, we're covering the full stack. This isn't just buy low, sell high. We're going to look at the sensors, how your bot actually sees the world. Then we're going to look at the brain, how it decides if the market is safe or if it's dangerous. Then the simulation, which is how to test properly so you don't lie to yourself.
Which is so easy to do.
So easy. And finally, the plumbing, which is the boring but absolutely critical stuff about API limits and how to avoid getting banned by your exchange.
And trust me, you are going to want to stick around for the plumbing section because apparently there's an error code called "I'm a teapot."
There is.
And if you see it, your trading career might be over for a few days. But okay, let's start at the beginning, the sensors. You made a really interesting point when we were prepping for this. You said that humans have a perception privilege that bots just don't have.
Exactly. Just think about it for a second. When you look at a chart, you instantly know, oh, the price is going up, or man, it's chopping sideways, or wow, that looks scary.
It's intuitive.
It's completely intuitive. Your brain processes all that visual data instantly. It integrates thousands of data points into a feeling. A bot doesn't see a chart. It just sees a stream of numbers.
A timestamp and a price.
A timestamp and a price. That's it. For all intents and purposes, it's blind. So if you want a bot to trade a trend, you have to mathematically translate that feeling that looks like a trend into a hard number that the code can actually understand.
And that's the first hurdle.
It's the first, and honestly, it's where most people go wrong right away. They try to use, price direction as a sensor. But price is noisy. It's messy. We need to measure the quality of the movement, not just the direction.
The quality. And this brings us to the IDX, or the average directional index. I've seen this on my charts, but I usually ignore it because it just looks like a tangled mess of 3 different lines. But the sources describe this as the volume knob of a trend.
That is the perfect way to put it.
Let's unpack that. Why is this the first sensor we need to build for our bot?
So the ADX is unique because it doesn't tell you where the price is going. It couldn't care less if the price is crashing to 0 or, mooning to 1,000,000.
So it's not a directional indicator.
Not at all. It only measures the strength of that movement, the intensity. Think of it like the speedometer in your car. It tells you you're going 100 miles per hour, but it doesn't tell you if you're driving north toward the beach or south off a cliff.
Okay, that makes sense. So if I'm building a bot, how do I use that? Because, knowing I'm going fast is useful, but I kind of need to know the direction too, right?
You do, absolutely. And the ADX indicator actually comes with 2 other lines, the DI plus and the DI. Those are your directional indicators. They literally tell you who's winning the tug of war, the buyers or the sellers.
Okay, so DI plus is bullish momentum, DI is bearish.
Exactly. But the main ADX line itself, that single solid line, that is your filter, that's your gatekeeper. The sources highlight some magic numbers here that help define the market state. And the most critical one by far is 20.
20.
If the ADX is below 20, you are in what the pros call the dead zone.
The dead zone. That sounds ominous. What happens in the dead zone?
It's the bot killer. It's where strategies go to die. When ADX is below 20, the market is driftless, it's ranging, it's messy, there's just no momentum, no conviction. The price is just wandering around aimlessly.
Oh, it's noise.
It's pure noise. And if you are running a trend-following strategy, like a simple moving average crossover in a sub-20 ADX environment, you're going to get chopped to pieces. This is where you experience whipsaws.
I know that feeling.
Oh, yeah. You'll buy the breakout because the price ticked up a little, and it immediately reverses on you. You'll sell the breakdown, and then it rallies right back up.
Yeah.
You just bleed money on fees and slippage without the market ever actually going anywhere.
So the first rule of the algo trading blueprint is check the volume knob. If it's below 20, the trend bot needs to stay on the sidelines.
Precisely. Or you have to be smart enough to switch strategies. This is key. If you're under 20, you shouldn't be looking for trends. You should be running a mean reversion strategy.
So you're betting it'll come back to the average price.
You're betting it'll bounce. You assume the price will bounce back to the middle. But the moment that ADX line starts to rise and crosses above, say, 25, that is your go signal.
Okay.
That tells the bot, okay, a trend is building, inertia has kicked in, start fading the moves and start riding them.
It's like waiting for the wave to actually form before you start paddling. It's about patience.
It's all about patience.
Now, what about when it gets really high? I saw a note here in the sources about ADX above 50. Is bigger always better?
That's where it gets tricky and, frankly, where a lot of amateur bots get caught holding the bag.
Buying the top.
Buying the absolute top. If ADX is above 50, the trend is incredibly strong. It's a roaring engine. But statistically, it's also potentially overheated. It's exhausted. If your bot is just now entering a trade when ADX hits 50, you might be the last person to the party.
So what's the real signal then?
The Holy Grail setup, according to the sources we looked at, isn't just a high ADX. It's a rising ADX.
So the slope matters more than the absolute number?
The slope is everything, the rate of change. If ADX is at 40, but it's flatlining, or worse, curling down, the trend is tired. It's running out of gas. Momentum is fading, even if the price is still kind of drifting up.
Inertia.
Exactly. You want to catch it when it's accelerating.
Yeah.
When it's going from, say, 25 to 30 to 35. That is the sweet spot where the move is real, it's confirmed, but it's not yet exhausted.
That makes perfect sense. It's about the second derivative, really. The rate of change of the strength.
You got it.
Okay, so let's talk about boundaries. The ADX tells us about the energy, but we need to give the bot a way to see normal versus abnormal price action. This brings us to what the outline called the Battle of the Channels. We've got Donchian, Bollinger, and Keltner. It sounds like a law firm, but these are actually three different ways of drawing a box around the price.
It does sound like a law firm, doesn't it? Donchian, Bollinger, and Keltner. We sue bad trades. But they are very different tools with very different philosophies baked into them.
Let's start with Donchian. That one feels like the most old school.
It is. Let's start with Donchian channels. These are the simplest, and they're famous because of the Turtle Traders experiment back in the 80s. A Donchian channel just plots the highest high and the lowest low over the last n periods. That's it.
So like the highest price in the last 20 days and the lowest price in the last 20 days.
Exactly. It's a raw price box. No statistics, no fancy math, just pure price action.
So if the price breaks out of the top of that box, you buy.
That's the classic strategy. It's a pure breakout tool. If price makes a new 20-day high, the Donchian channel expands up and you buy. The philosophy behind it is simply new highs lead to higher highs.
But I can already see the problem. What if the market isn't trending?
You've hit on its weakness. The problem, again, is the regime. In a sideways market, a low ADX market, the price might just poke its head out of the box for 1 second, trigger your buy order, and then fall right back in. The ultimate whipsaw. Donchian channels are fantastic for catching massive secular trends like, think about Bitcoin in late 2020. But they are absolutely brutal in choppy markets because they have no filter for noise. They treat every move as significant.
Which brings us to Bollinger Bands. These seem to be the most popular. I see them on every crypto influencer's chart. What makes them different?
They are popular for a reason. Bollinger Bands are based on standard deviation. This is a statistical measure of volatility. So unlike Donchian channels, which are rigid and based on past highs and lows, Bollinger Bands are elastic.
They stretch and contract.
Exactly. When the market is quiet, the bands contract and get super tight. When the market goes crazy, the bands expand. They literally breathe with the market. They adapt to the current volatility.
And there's this concept of the squeeze that the sources mention. This feels like a really actionable insight for a bot.
The squeeze is one of the most powerful concepts in volatility trading. It's so reliable because it relies on a fundamental truth of markets. Volatility is cyclical.
It goes from low to high and back to low.
Always. It breathes. So when those bands get incredibly narrow, when the standard deviation collapses to almost nothing, it's like compressing a spring. The market has been quiet for too long. It's building up potential energy.
So the bot sees tight bands and thinks something big is about to happen.
Precisely. It doesn't know which way the explosion will go yet, up or down, but it knows an explosion is imminent. It's a heads-up signal. It tells the bot to pay attention.
But the sources mention a specific advanced setup combining Bollinger with Keltner channels. This is getting into the weeds a bit. This is the sniper technique.
That's where it gets really cool. Yeah.
How does that combination work? Why add another set of bands?
So Keltner channels look similar to Bollinger bands, but they're calculated differently. They're based on ATR average true range.
Which is a different measure of volatility.
A different, and some would say a smoother, less twitchy measure of volatility than standard deviation. So you can think of the Keltner channels as representing the steady or average volatility. Now, usually the Bollinger bands are wider than the Keltner channels because price is noisy and standard deviation will pick up all that short-term craziness. But during a period of super low volatility, the Bollinger bands will contract so much that they actually go inside the Keltner channels.
Oh, wow. So the short-term twitchy volatility becomes lower than the long-term steady volatility.
Exactly. The rubber band is wound tighter than the steady average. When the Bollinger bands slip inside the Keltner channels, that is what traders call a critical squeeze. That is your signal to wake the bot up and prepare for a massive breakout.
It's a purely mechanical way to identify the calm before the storm.
A purely mechanical, quantifiable signal. You can code your bot to say, if Bollinger band width is less than Keltner channel width, then enter high alert mode. It's a visual trigger that you can turn into simple, clean logic.
I love that. Okay, so we have our sensors. We know how to measure trend strength with ADX. We know how to spot these volatility squeezes with the channels. But simply reacting to these indicators isn't enough, right? We need to understand the bigger picture.
We need a brain.
We need a brain.
Correct. And this is where we move from basic technical analysis to, real quantitative engineering. We need to talk about market regimes because, as we said in the intro, running a trend strategy in a range market is suicide. We need a classifier.
The bot needs to be self-aware.
It needs the bot to look at the market and say, this is a bull regime, or this is a bear regime, or, most importantly, this is a volatile crash regime. And it has to know what to do in each of those situations.
And this isn't just about price going up or down. The sources talk about volatility clustering, specifically in crypto. What does that mean? Sticky volatility.
It's a fascinating characteristic of crypto markets and honestly all financial markets, but it's just amplified in crypto. Volatility is sticky. It clusters. What that means is if yesterday was a crazy high volatility day with 10% swings, statistically, today is also likely to be a high volatility day.
So it's not random. It doesn't just flip a coin every morning to decide if it's going to be crazy.
No, not at all. It has memory. Calm days tend to follow calm days. Storms tend to follow storms. And that persistence is exploitable. If your bot detects a spike in volatility, it should assume that high volatility is here to stay for a bit. It shouldn't just assume things will instantly calm down.
That's a huge insight.
But there's another layer to this from the ResearchGate paper we looked at. They describe something called the locomotive effect.
Right. This was about the relationship between Bitcoin and Ethereum.
Yes. The research shows that in a calm regime, crypto assets move somewhat independently. Ethereum might do its own thing based on some DeFi news, while Bitcoin just chops sideways. The correlation between them is lower.
They have their own stories.
Exactly. But when the regime shifts to volatile or crash, Bitcoin becomes the locomotive.
It takes over.
It completely takes over. The interdependencies spike. The correlations all go towards one. Bitcoin drags everything else with it, whether it's up or down. If the locomotive is running off a cliff, it's taking every single car on that train with it.
That is crucial for anyone out there trading altcoins. If Bitcoin enters a volatile regime, your fancy technical analysis on that small cap coin might not matter at all.
It probably doesn't matter. The locomotive is coming through. If you are trading an altcoin, your bot cannot just look at that altcoin. It has to look at the king.
It needs a Bitcoin regime sensor.
100%. If Bitcoin is in a crash regime,
Hmm.
your bot should probably sell the altcoin, even if the altcoin's chart looks perfect.
Hmm.
The macro force overrides the micro setup every time in that environment.
So how do we build this regime detector? This is where the sources get pretty heavy into the math. They talk about hidden Markov models, or HMM. That sounds like something from a spy novel or a quantum physics lab. Can we break that down into plain English?
Let's try. The weather analogy is honestly the best way to understand HMMs. Imagine you are locked in a windowless room.
Yeah.
A bunker. You can't see outside at all.
Okay.
You want to know if it's raining or sunny? That's the hidden state, the regime. You can't observe it directly because you're stuck in the bunker.
Okay, I'm in the bunker. How do I know the weather?
You have a security camera pointed at the hallway where people walk in from the street. You can see if they're carrying umbrellas or if they're wearing sunglasses or taking off heavy wet coats. Those are the observations,
The data I can see.
the data you can see. In our case, the observations are the market's daily returns and its volatility. An HMM is a mathematical model that allows you to calculate the probability of the hidden state rain based on the observations you're seeing, the umbrellas.
So if I see 3 people walk in with dripping wet umbrellas, the model calculates that there's like a 95% chance the hidden state is rain.
Exactly. But it's smarter than that.
Yeah.
Because what if one person walks in with an umbrella, but it's dry?
Maybe they just carry it out of habit.
Right. The model deals with that noise and uncertainty. In trading, the HMM looks at the continuous stream of returns and volatility, the umbrellas, and it calculates the probability of the current regime. Is it a steady bull state with low volatility and positive returns? Is it a volatile crash state with high volatility and negative returns?
And it's not a binary yes or no.
That's the beauty of it. It gives you a probability. It might come back and say, based on today's price action, there's a 90% chance we're in a high volatility regime tomorrow.
And that is actionable. If the probability of high volatility is 90%, what does the bot do?
It adapts. That's the key. A dumb bot just keeps trading the same way no matter what. A smart bot using an HMM sees that high crash probability and automatically changes its behavior.
How so?
Well, it might reduce its position size. If you usually trade with $1,000, maybe in a volatile regime you only trade with 100, or it tightens its stop losses. Or, frankly, it just goes to cash. It sits on its hands.
It turns itself off.
Yes. Sometimes the most profitable trade is no trade at all. If the HMM detects a choppy sideways regime, the bot can be programmed to switch from its trend-following module to a grid trading module, which is specifically designed to profit from that kind of chop.
You are essentially changing the engine of the car while you are driving based on the road conditions.
That's a perfect analogy.
Yeah.
You are. Instead of optimizing the strategy parameters, you're optimizing the selection of the strategy itself.
That is next level. The sources also mention the JAR-CH family of models. Is that similar to an HMM?
It's related. YAR-CH models are specifically for modeling the volatility itself, not necessarily classifying the regime. The key takeaway from the YAR-CH sources for our purpose is the concept of asymmetry.
Okay.
In crypto and most markets, negative shocks crashes spike volatility much, much more than positive shocks do.
Panic is louder than greed.
Panic is louder than greed. I love that. I'm going to use that. It's so true. Models like eGAR-CH are designed to capture that leverage effect. A 5% drop in price might cause volatility to double, but a 5% rally might only cause volatility to go up by, say, 10%. Your bot needs to know that the downside is faster, sharper, and more violent than the upside. You can't treat them equally.
So we have our sensors, the ADX and the channels, and we have our brain the regime detection with HMMs. Now we've built this thing and we need to test it. We enter the matrix, the simulation.
Ah, backtesting. This is where dreams are born and where bank accounts go to die. Because a backtest is a lie. We have to start there. It is a perfect simulation of what would have happened, assuming you could trade perfectly in a world that doesn't exist anymore.
The sources list some cardinal sins of backtesting, and the biggest one seems to be overfitting. I feel like I've done this. I tweak the numbers until the chart looks green.
We've all done it. Overfitting is basically cheating without realizing you're cheating. It's seduction. Let's say you have a strategy based on the RSI indicator. The default setting is 14 periods. You run a test on last year's data, and it makes 10%.
Not bad.
Not bad. But you want more. You want that Lambo. So you change the RSI to 13, now it makes 12%. You change it to 12, it makes 8%. Then you try RSI 13.5. Suddenly, boom, 50% profit. You found the secret.
So you stick with RSI 13.5. That's the magic number.
Right. But the problem is, there's nothing magical about the number 13.5. You just found a number that happened to perfectly fit the random noise of that specific year. It's curve fitting. It's like drawing a super complex line that perfectly hits every dot in a random scatter plot.
It looks perfect in the past.
But the moment you run it on new data, the future, it fails completely because that specific random pattern of noise doesn't repeat. You haven't found a strategy. You've just memorized history.
So how do we avoid that? How do we know if we have a real edge or just a lucky number?
One of the best methods is called walk-forward analysis. This is the gold standard for testing. Instead of testing on all your data at once, you split it up. Let's say you have data from 2020 to 2025.
Okay.
You optimize your parameters using only 2020 data. You let the computer test every RSI setting from 2 to 50, but only on that 1 year. Maybe the best RSI for 2020 was 14. Then you lock that setting, you cannot change it, and you test it blind on 2021 data.
You force the bot to walk forward into the unknown.
Exactly. You are simulating the actual passage of time. If it survives 2021, great. Then you take your 2021 data, you re-optimize your parameters on that, and you walk forward into 2022. This simulates the actual experience of a trader adapting over time.
And if it fails?
If your strategy makes $1 million in a standard backtest but crashes and burns in the first walk-forward phase, it was overfit. It was never a real strategy. It was just a history lesson.
That sounds brutal, but absolutely necessary. The other technique mentioned is Monte Carlo simulation. That just sounds like gambling.
It's named after the casino, yes. But it's about testing your luck, or rather your strategy's resilience to bad luck. Let's say your backtest shows a nice, steady equity curve going up and to the right.
The dream.
The dream. A Monte Carlo simulation takes all your individual trades, the wins and the losses, and it shuffles them like a deck of cards. It randomizes the order in which they occurred.
Why does the order matter? I mean, if I win 60% of the time, I win 60% of the time, right? The end result should be the same.
Not necessarily. Sequence risk is a very real and very dangerous thing. Imagine you have a strategy that wins 60% of the time. But what if, just by pure bad luck, you happen to hit a streak of 10 losses in a row right at the beginning?
Oh.
Would that blow up your account? Would you run out of margin?
I see. If I start with $1,000 and lose 10 times in a row, I might be at zero before I ever hit my winning streak.
Precisely. A Monte Carlo simulation runs thousands of these different shuffles. It shows you the full distribution of possible outcomes, including the worst-case scenario. It might tell you, hey, 95% of the time you make money, but 5% of the time, a specific sequence of bad trades wipes you out completely.
And you need to know if that 5% risk is acceptable.
You'd rather know that in the simulation than with real money. You want to break your bot in the simulation so it doesn't break in reality.
And speaking of reality, we have to talk about execution reality. This is the invisible thief. Slippage and fees.
Silent killers.
I feel like new traders always ignore fees. They see 0.1% fee and think it's nothing.
It feels like nothing on one trade. But if you are high-frequency trading, let's say your bot trades 50 times a day, that 0.1% fee happens on the buy and on the sell.
So that's 0.2% per round trip.
Right. Multiply that by 50 trades. You are paying 10% of your portfolio in fees every single day just to participate.
Wow. Put that way, it's insane. You need a massive edge just to break even.
Exactly. A strategy with a 51% win rate, which sounds good, will bleed to death on fees. You have to factor realistic fees into the simulation. And then there's slippage, the fact that you rarely get filled at the exact price you see on the screen.
The price moves between when you click and when the order executes.
Always. If you want to buy at 100, you might get filled at 100.05 because the market is moving fast. That tiny difference compounds. Your backtest assumes you bought at 100.00. Reality charges you 100.05. Over 1,000 trades, that tiny difference can easily turn a winning strategy into a losing one.
So the lesson for the simulation phase is be a pessimist, assume the worst, add in high fees, add in slippage, shuffle the deck with Monte Carlo, and walk it forward. If the strategy still makes money after all that bullying,
then maybe, just maybe, it's ready for the plumbing phase.
The plumbing, the unsexy infrastructure that keeps the lights on. We are talking specifically about the Binance API here in the sources, but this applies to most crypto exchanges.
It really does. You can have the Nobel Prize-winning math model, but if you don't understand how the API works, you will fail. Full stop.
And the scary part here is the ban. I genuinely didn't realize exchanges would just ban you for asking for the price too often.
Oh, they absolutely will. And you have to see it from their perspective. It's a resource issue. Binance has millions of users. If your poorly coded bot is spamming their server asking, what's the price, what's the price, what's the price? 1,000 times a second,
You're not a trader, you're an attack.
you're acting like a DDoS attack. You are clogging the pipes for everyone else.
So how do they measure that? Is it just the number of messages you send?
It's a weight system. This is crucial for anyone writing code to understand. Not all requests are created equal. Checking an existing order status might be low weight, say it costs 1 point, but asking for the entire order book history, the depth chart, that might be high weight, say a cost of 50 points.
And you have a budget.
You have a budget per minute. If you exceed that weight budget, you start getting hit with errors.
And this is where the famous error codes come in.
Right. First, you get a 429 error. It stands for too many requests.
Oh.
It's a polite warning. It's the server saying, hey, slow down. You're talking too fast.
Yeah.
If your bot is well designed, it catches that error and pauses. It takes a breath. It sleeps for a second and tries again.
And if your bot is dumb and just keeps screaming at the server?
Then you get the 418.
The teapot.
The 418 error. The official HTTP standard defines code 418 as I'm a teapot. It's an old developer joke from the 90s, but on Binance, it means you are IP banned. You are done.
So the server's saying, I am a teapot, I cannot brew coffee for you, and I definitely cannot process your trades because you are blocked.
That's literally what it means. And that ban can last from 2 minutes up to 3 days. Imagine the market crashing while your bot is banned and can't sell your positions.
That's a nightmare. You are locked out of the house while it's burning down.
It is a catastrophe. So to avoid the teapot, you have to fundamentally change how you get data. You don't poll the API. You don't ask what is the price over and over. You use WebSockets.
WebSockets, that's like a live stream, right? You subscribe instead of asking.
Exactly. Instead of you calling them, you open a persistent channel and they call you. They push the data to you the millisecond it changes. Price changed, new trade executed, order book updated. It uses almost zero weight from your budget because you aren't making requests. You're just listening.
Which frees up your weight budget for the important stuff.
Execution, placing orders, canceling orders, the things that actually matter.
That makes total sense. Listen for free, pay to trade. Now, speaking of execution safety, the sources highlight OCO orders. One cancels the other. Why is this so essential for a bot?
Because the internet is fragile. Your bot runs on a server somewhere. That server can crash. Your Wi-Fi can go down. The exchange API itself can lag. Let's say your bot buys Bitcoin. It then calculates where the stop loss should be. But before it can send that separate stop loss order, your internet cuts out.
So now I'm just holding Bitcoin with no stop loss. I'm naked in the market.
You are completely exposed. If the market crashes 20% while your internet is down, you are ruined. An OCO order solves this. It lets you bundle the exit strategy. You tell the exchange, if price goes up to $70, sell for profit. Or if it drops to $60K, sell for a loss. And if one of those orders happens, automatically cancel the other one.
And the key is that those orders live on the exchange's server.
That's the key. They live on the exchange's books, not in your bot's memory. So if your bot crashes or your laptop catches fire, your safety net is still active and waiting on the exchange itself.
That is just its peace of mind. And finally, the last piece of clumbing. The kill switch. This sounds dramatic, but necessary.
It needs to be dramatic. Every single algorithmic trader I know has a horror story of a bug, a decimal point in the wrong place, a logical loop that goes rogue. Imagine a loop that just buys, sells infinitely. It doesn't make or lose money on the trades, but it just racks up fees. It can drain a wallet in minutes.
So you need a circuit breaker, like in your house.
Exactly. A hard-coded rule in your bot that says, if my total account equity drops by more than, say, 5% in one day, stop everything. Close all positions, cancel all open orders, and shut down the program. And do not restart until a human reviews the logs.
This prevents a small bug from becoming a catastrophic failure.
It prevents a bad algorithm from draining your life savings in 10 minutes while you're asleep.
While you're asleep is the key phrase there. We want these bots to work for us, not destroy us in our sleep.
That is the goal, yes.
So let's try to synthesize this whole deep dive. We've gone on quite a journey here. We started with the sensors.
Right. Using ADX to measure the difference between a drift and a real drive, and using that Bollinger-Keltner squeeze to spot incoming explosions.
Then we built the brain, using HMMs and volatility clustering to classify the market regime. We learned that we have to trade differently in a bull trend versus a volatile crash.
And that sometimes the best trade is to just turn the whole thing off.
Then we ran it through the simulation, avoiding those cardinal sins of overfitting, acknowledging the real pain of fees and slippage, and using walk-forward analysis to make sure we aren't just memorizing the past.
And finally, we plumbed it all up, right?
Oh.
Using WebSockets to avoid the dreaded teapot ban and using OCO orders and kill switches to keep our capital safe from our own bad code.
It really changes your perspective on what a trader even is. In this world, you aren't the operator anymore. You aren't the person clicking the buttons, reacting to every single tick on the chart.
No, you are the architect. You're designing the engine. You're the system monitor. It's a completely different, higher level of abstraction. You're moving from playing the game to designing the game player.
Which brings us to our final provocative thought for you, the listener. And this one really stuck with me from the notes. We are in a market that is increasingly dominated by algorithms. Everyone is looking at the same RSI. Everyone has access to the same Bollinger Bands. Everyone can code these tools.
Right. If everyone has the same map, does the map still have value?
Exactly. So does the edge actually lie in the signal anymore? Is the edge really in finding the perfect entry price? Or is the only true remaining edge the ability to detect the regime change faster than the other bots?
That's the multi-million-dollar question, isn't it? I think the edge is no longer when to buy. The edge is knowing when to turn the machine off.
The edge is in the silence.
The edge is in the silence. The edge is recognizing that the storm is coming before the first drop of rain even hits the ground, and having the discipline to sit on your hands while everyone else's algorithms are getting chopped up in the volatility.
Wow. The edge is in the silence. I love that. A massive thank you for breaking all this down. For all you learners out there, don't just copy-paste code from the internet. Understand the environment. Check your ADX. Watch out for the teapot. And we will catch you on the next deep dive.
Trade safe, everyone.